Hello.
Hey, Mike, how are you?
Good. Oh, let me shut my door.
Give me, I gotta change my audio here. Okay, can you hear me?
I can hear you just fine.
Great, great.
Oh,
Let me share my
I don't have
screen.
my materials exchange hat. Shit.
Yeah, you got your shirt on now.
Got the shirt today. There we go.
Let me slideshow from beginning. Let me set all this up. Share screen. So let me know when we're live and you're ready to go.
We're live, ready to go. We have
All
been
right.
live.
Hello, everybody.
Hello, hello, hello.
Um, Lots of between the Can4 announcement last night, and so that everybody's aware, Can4 announced that, and I'll read this. Or actually, I'll do better. I'll just drag it in here to the screen so everybody can see that. Let's see. Can you see that?
Oh, I got to turn it on. There we go.
Okay, so basically, Can4 is saying end of year production curtailments in BC through the end of 2022. That's going to result in another 200 million board feet of production capacity. So this is just a continuation of what they've had for basically since I think it's been May. And it makes sense. There's still major rail car issues in BC. Um, from what you can ship, building out log decks, blah blah blah. I think you're going to continue to see more of this from the big two in BC, where Canfor's doing it for the rest of the year. I would assume that Fraser will follow suit, and it's not going to surprise me if you see another one or two announcements of permanent curtailments that happened this year coming out of BC from the big three. Um, so that's the first big thing today, and then the second one that we'll talk about is housing starts were out today, and the headline starts number was better than forecast. The headline permits number was worse than forecast. So it just depends on what side of the fence you fall on. But we'll go over the details of the actual numbers and kind of dive into why the numbers were what they were, or I'll give you my 2 cents analysis anyway. But lumber, as a result, front month November is 517 up 34.80. The high so far is 23.40. This is after making a low yesterday morning in that 461 area. So,
Yep.
we've had a nice bounce. All this with the major sawmill still 510 on the market this morning with wood for this week. So let's see here. Let's jump in here. So we'll
Oh,
start.
you got to share your screen
Oh,
there,
did
buddy.
I turn that off? Okay, let's see here. Okay, there we go. We're good. You
Oh,
can see the screen? There you go.
there we
Okay.
go.
So the big takeaway is, to me, here's equities kind of stumbling around, crude oil stumbling around, lumber stumbling around, but the big thing that jumps out is the purple line, 10-year notes, 2-year notes, 30-year mortgage rates in anticipation of the FOMC announcement tomorrow. 10-year notes made a new 15-year high, up over 3 point, and I think this is actually, yeah, I'm sorry, they're up to 3.58. 2-year notes are just under 4%. And Treasury, I'm sorry, 30-year mortgage rates are in that 6.24 area. So market is freaking out. We're anticipating at least a 0.75 basis increase tomorrow with FOMC. I think if it's a full point, the market freaks out. If it's less than 0.75, the market freaks out. If it's 0.75, I think that's the expectation, and it'll all boil down to what Powell says tomorrow in his presser as far as just what he sees inflation. And, I'll remind people that the Fed's two-pronged approach to dealing with inflation, the obvious one is raising interest rates. The other kind of becoming more obvious one is a strong US dollar. That makes dollar denominated commodities weaker, and that's the full court press by the Fed right now. Let's raise rates. Let's keep a strong dollar. The dollar's a $1.10. We've talked about kind of you're at anywhere from 20 to 35-year lows with other foreign currencies like the British pound, the yen, the euro. So we're going to make our goods the cheapest goods out there, and everybody else be damned. Deal with it. We're going to take care of ourselves first, and that's what that's kind of how we're controlling or trying to rein in inflation. It's that raise interest rates and strong U.S. dollar policy. And you can see that in this next chart. I mean, here's US dollar still strong. And as a result, dollar denominated commodities, here's wheat, here's crude oil, copper, lumber, gold. Gold continues to be the big surprise here. But, this is kind of for appreciation in physical commodities now. You're really going to need underlying fundamental rationale. Uh, um, underlying demand supply dynamics to play out to fight that appreciating US dollar, or you're going to need signs that the dollar is topping out. And, as much as I want to say we're in top out mode, we're within striking distance. We were just under a $1.10 this morning. The high was 109.99. We're 109.87 right now.
And I mean that the dollar, I think, has headwinds at going much higher because the rest of the world is really jumping on the rate raising bandwagon.
Yeah, and I'll show you the chart here, Mike. Somebody says I have audio but no video. Is video on? Let's just make sure.
I think it's just him. I think the video should be working. Well, you know what? Yeah. I can see it on my phone, so we're good there.
Okay, good. Okay. Everybody wants to see our pretty faces. So
well, Sweden just raised by 1 full percentage point.
Yeah. So I'll come back to this, but this is the obvious. Okay, when you have FedEx, their CEO come out when he's asked point blank last week by Jim Cramer on CNBC, are we going into a global recession? He didn't even pause. He said, yeah, we're going into a global recession. So it's tough to fight that kind of, do you think FedEx sees it globally first and everything that they do on a day-to-day basis?
They touch a lot of boxes.
Yeah. I think I might, if I'm the Fed, pay attention to what FedEx is saying. But it's pretty, amazing where the threat of a global recession. Well, what's the safe haven? The obvious safe haven is U.S. dollar, U.S. denominated assets, and look at the U.S. net capital inflows. So look at the inflow of U.S. dollars coming in here. You're surging. So everybody else is fleeing their own domestic currencies, flowing into U.S. dollar. So look at net foreign purchases skyrocketing here, and then look at private net foreign purchases. Nobody's buying anything globally. They're buying everything U.S. based. So I think that speaks volume as far as, don't fight King Dollar. And right now, this is in my mind, this is the real way. Interest rates are the obvious one. Everybody's expectation rates are going higher, but this is this is the real approach. Strong U.S. dollar to weaken physical commodities to rein in inflation. That's kind of the obvious. To me, that's how the Fed will have the most tangible, real results the quickest is strong U.S. dollar, and that's what you're seeing. So we'll jump back here. As a result, so you look at commodities on a 1-month basis. Lumber's finally off that red screen, so we're up
cool.
over 1% for the month. And this is as of yesterday's close, so this would actually be higher as of today. But you've got the grain markets here, so the grains are more fundamental based as far as supply, planting conditions, kind of harvest, that kind of stuff, where you have supply driven issues. There's your U.S. dollar. VIX is increasing for the obviously equities here. So those are the obvious winners. Look at the losers here. Well, 10-year notes. So we know inversely, as rates go up, prices of treasuries go down. So rates just skyrocketed back up. So you see 10-year notes, 30-year notes, ultra T-bond, interest rates are going higher. Yields are moving higher. Net impact, you got copper, you've got gold. Here's the Goldman Sachs commodity index. You've got crude oil. You've got S&P, the Dow. Anything dollar denominated asset wise is getting taken to the woodshed right now, and that to me that dovetails into the strong U.S. dollar more so than anything else.
What are the bottom two there, Greg? Your name's covering it up.
Let's see here. I'm sorry. Bottom two are cotton and then micro ether. Whatchamacallit?
Okay.
Another. That's a new. That's cyber. That's a new Bitcoin type
Yeah,
futures
got
on
it.
the CME. So we'll jump to. So I know we talked about crude oil a couple of weeks ago and energies in general, and there's been some big shifts in the Ukraine. The saber rattling is becoming less and less of a threat with Russia, and so because of that strong U.S. dollar policy, you're starting to get signs that crude oil, the highs are in, and you're going to have this pattern of lower lows, lower highs, lower lows, where if crude oil breaks under $80, you could easily see a washout to $75 to $65. And I think, let me see here. Yeah, sorry, my name is, I just saw Matt's thing. But yeah, it's the point is you better have good fundamental justification in trying to pick bottoms in commodities now, where it's not going to be all commodities are a buy. You have supply dynamics, obviously, but the demand component in just about everything globally now is under fire. So you better have a good fundamental perspective in trying to pick bottoms in physical commodities right now. And I'll say that with lumber as well. And we'll get into the details there. So again, the headlines with interest rates, yields on 2-year, 10-year notch new highs. So again, you're basically at 15-year highs now on the 2-year and 10-year. Mortgage rates surged to new 14-year highs, this is as of yesterday, but you're in the 6.25 to 6.4 area, depending on where you look. Mortgage rate trends, you're back above 6% here.
I'm going to share something real quick too. This was an article that jumped out at me. So this is on Bloomberg, how much a new monthly mortgage payment has surged in 10 metro areas. And I mean, these charts are remarkable. So this is Austin, Texas. And, at the beginning of the pandemic, mortgage on the median existing home price was $1,100. It's $3,000. So it just, everybody wants to talk about the absolute price of the home. The price of a house is irrelevant. It's really the price of the mortgage for 70% of the people buying homes.
Well, not only that, but that massive mortgage increase is not buying you the same home. I mean, that's that 3,500 square foot home is probably 3,000 or 2,800 now with that higher payment. So
look at Boise is up 2.5%. Akron, Ohio, doubled.
Yeah, even Akron, look at that.
Miami, Florida, almost up 3%. So, this combination, where the guy who wrote this or person who wrote this article was going is that are home prices sustainable at these levels? I can't imagine that the chart would go much higher. Every move higher in the mortgage rate just makes the monthly payment that much more expensive.
Well, not only that, but the person selling has to go somewhere. And so you just think at some point, To me anyway, you look at these, mortgage trends, the likelihood of higher rates, where I think the Fed goes 0.75. I think they go 0.5 next month. They take a breather for November because of the elections. And then there's this resumption. But the idea you're going to see the Fed pause and then pull back rates into Q1 next year, you're going to need consecutive months showing that inflation is under check. And, you know, kind of some of the other things I have here, where inflation is and where isn't. Okay. So we know that gasoline prices, we see this at the pump, have come down substantially. But look at, food at home. Look at, some of the other things that people touch on a daily basis: housing, rent, a lot of these things. And you'll see it in bill. I've got charts on building materials. Let me turn this off, Mike. Um, uh, uh, I've got, it's the idea that inflation, CPI, PPA are topping out. Well, they might be topping out with energy, but energy is one component of core inflation. And so, this kind of meshes into the charts you just showed, Mike. I mean, consumer price inflation when it comes to housing. So year over year, housing is up 7.8% in August consumer CPI. So consumer, that's the end user. Payments are up. Mortgages are up 7.8%. Look at the trend. I mean, you're still trending higher. So to say that we've topped is one thing, but where's this big flush back to the downside? And again, bear in mind that when you look at PPI, CPI, you look at inflation, the Fed's own inflationary numbers are forecasting 2.5 to 3%. You're just going to collapse back down back to these numbers. And Matt, Layman just asked, is technical analysis applicable to the bonds in this environment? Absolutely. You just have to include monthly and weekly charts now. Instead of just trading off of dailies with treasuries, you're going back to weekly, monthly charts from a Fibonacci, from a Bollinger Band standpoint, because you're surging back to these 10, 15 plus year highs now as far as rates are concerned. So, let's get into, okay, housing in the news. So here's your building material inflation. And so here's price inputs of residential construction. Um, okay, we're moderating. We're still up dramatically, but we're seeing signs of at least going sideways. And a big part of it, obviously, is gas and lumber, which are two big components in anything. But as you start to, so here's softwood lumber prices. Okay, you can say that inflation is over with. We're this reversion back to the mean in pricing. Well, okay, here's steel mill prices. Okay, we've topped out, but I don't see this big collapse in prices with steel. Here's gypsum board. Does this look like this is topping out? You're still making new highs. Here's change in ready mix concrete prices. Okay, this is by region. Change in ready mix concrete prices aggregately. This is what the Fed is looking at, all this stuff. And again, energy is one component, an important, albeit an important component of inflation, but it's not the end all be all. So when you look at food, you look at all these other things, that has to be taken into consideration when they view inflation. So that's why, the idea that they're just going to let up on the wheel here. No, they want to see all these things starting to trend back to the downside. And so far, you're not there. Here's price changes of raw material inputs to transformers. Here's your electrical that goes into a house. Okay. Look at these changes year over year since, the blue is year over year since January 2020, there's no signs of inflation abating when it comes to the electrical components that go into residential and commercial.
Well, there's no doubt, though. Energy prices bleed through in everything. I mean, I haven't seen a sawmill or a steel mill or a copper wire factory that doesn't run on some sort of energy.
Yeah, absolutely. Absolutely. And so here's your change in freight transportation prices. So, we know that truck prices are starting to moderate, but you're still up year to date substantially. And then since 2021, you're up dramatically. And again, what the Fed is looking for with all of this is they want to see this collective aggregate kind of all commodities starting to trend back down. So
Yep.
there's where your strong dollar policy comes in, because you want to start to see just just prices, PPI, producer prices, manufacturing prices, as well as CPI prices start to moderate collectively. Not just, energy is great, but you need to see it everywhere else for them to pump the brakes and say, we did it. We've got inflation under control. So we'll jump. Yesterday we had builder confidence. The headline was builder confidence, NHAB builder confidence falls for the ninth consecutive month. No surprise there. Um, and then today we had housing starts. Um, and the starts number was a good number. This is forecast to be 1.4 something starts. Permits were forecast to be 1.6 something, 1.61. Housing completions, when you look at the actual completions, were actually pretty good. But I know, Mike, we've talked about this chart here to the left. We talked about it, I think, 3 or 4 months ago, and at that point, you basically had this divergence between permits, starts, and completions, and we said that you're going to get this convergence, and that's what you're seeing. Where, if I want to take the most simplistic approach of where housing starts are headed, okay, look at completions, look at the trend in starts and permits, and I think this is going to be an aberration. And so the blue line here in starts obviously bounced back, but that coincides. Look at the end of July, look at the beginning of August. You had this bounce back in interest rates, where interest rates, the 30-year dropped below 5.5%. You had a pullback in the 10-year. So I think you had a lot of home builders and end user types that were sitting on the fence. And when you had this pullback in rates, the end of July, beginning of August, I think that pushed a lot of people into the marketplace. And I think, to me, that's as good of an explanation as any on why starts had this move back to the upside. But given where rates are today, you've had a complete collapse off of this move back up the end of August, end of July, beginning of August. The demand destruction is coming with starts.
Yeah.
Pure and simple, it's
Well,
going to
and
be multifamily, and we saw
exactly,
that.
today's
Yeah,
start
yeah,
number was a big multifamily number.
yeah.
Like, when you if you as far as the lumber market goes, when you factor in the amount of material used, it definitely is a smaller amount when housing starts are multifamily.
And so, the other thing I'll point out with actual housing starts, the headline number was good. When you look at it month over month, you were up nicely. Well, this 8.31, this is the single family component of starts. So you were actually down in single family. The gain was all concentrated in multi. You went, look, this is where you got that big number, that bump up in starts was the multifamily component. And then when we flip to actual homes under construction, actual housing, again, I look at the actual numbers. I'm a big fan of actual numbers versus the seasonally adjusted. But when you look at, homes under construction, this is really good. This is really good, but this is your single family component. Actual homes under construction, single family, was down month over month. The gains were all in multifamily. The shift is in multifamily moving higher. And then when you look at actual housing units completed, unfortunately, we were down. That this is good in that you completed a big jump in single family, but again, at the detriment of multi. And again, I know we're jumping all over here with starts, but the big takeaway, and I think we saw this last week at the BCMC show in Columbus, and I've seen this doing the Alex and I have been doing the road show as far as trying to drum up interest and support for the new contract. The multi-family segment is in really good shape. There's organic growth in
Yep.
multi. The single family is gone. That's gone, and it's not coming back until you rein in interest rates. The single family component is not coming back. Doesn't matter what kind of incentives you give people, unless you can have wage growth outpace inflation to more than make up for higher interest rates. The shift for housing starts is all into multi, and that's going to be your leader for the foreseeable future. So going back to what I was saying here, to me, the simplest way to kind of forecast housing starts permits is just take the aggregate of these three. So, again, this is my 2 cents, my opinion, but by the end of this year, you're going to have starts, permits, and completions all sub 1.45, potentially even in the low 0.14s, the high 1.3s by year end. That's where you're trending. That's where aggregate starts, permits are heading going into Q4, the end of Q4 of this year.
That's what the Fed wants. I mean,
Yeah,
it's
yeah.
don't fight the Fed.
So we'll jump into lumber. Obviously, September went off last week at 483.50. Collectively, there were 179 EFPs, of which 28 of them were the mini contracts. So there were the equivalent of 7 legacy contracts done in the minis, which is good. For the first contract out there, the fact that there were EFPs, that number is only going to grow exponentially.
Yeah, that's fantastic.
Yeah. And then skip over that. So here's your weekly continuation chart. And, this one is for the sawmills out there. Do you see a pattern with expiration prices here?
Yeah.
Demand's not the savior here. If you don't like these prices, do something about it. And, hats off to Canfor. They're pulling up their big boy pants here. But sawmills outside of BC, other sawmills in BC, if you don't like these prices, then the onus is on you. It's not going to be demand driven. It's going to have to be supply constraints. If you don't like $483 or lower, then do something about it from a supply standpoint.
Yeah, because the Fed's doing its job to destroy demand.
So, and I know we kind of talked about this last week, Mike, in Columbus, but so historically speaking, I thought this is great. Okay, there's value at September at sub $500. So the significance of the 483.50 close for September 22 legacy futures is it's the second highest expiration in the history of September futures. So the idea that there's value.
And what a terrible market we have.
Yeah. I mean, so be careful in that, the glass is half empty, the glass is half full. What's reality of what we just came out of versus reversion to the mean, the reality of what once was. Lumber's in that process of trying to figure that out right now. But I thought this was a great chart so people could visually see $484 September future expiration is the second highest on record. And we've got obviously well beyond this. So here's your November daily chart. You can see you're in this coiled triangle formation. Maybe you can get a breakout to the upside, but a breakout to do what? Where best case scenario is a retest of this 550, 560 area to 600. So technically speaking, that's kind of what, if you're going to say that this is a dead cat bounce rally, unless there's some kind of significant shift to the underlying fundamentals, technically you could bounce up to this level. Maybe you push more of the weak-handed funds out of the market, but I think the hope for the industry from a producer standpoint, and we'll see this in the CFTC numbers, is that we want the funds to push this thing so we can replace their shorts.
So my first glance at this is, whoa, that looks like a pretty substantial move out of a double bottom.
Yeah. Yep.
So I think there's some more data out that's going to prove my thesis a little bit stronger, but let's take a look.
So here's the Nov Jan spread. The spread came into, this shows -5. It only actually traded into the -850 area from a spread standpoint. You went back out to -2021. Obviously today you're back it's traded into a -1170 so far. Ideally, it gets back into this -10 to -8, maybe a -5 area. but my expectation would be it gets pushed back out going into month end, especially with the Rogers type rolls into month end. There's a good chance this spread gets pushed out one more time before you start the process of knowing that the funds are aggressively short November and they ultimately have to liquidate or roll into January. But that's typically, it's the 20th. That's a month from now into October. But before they're thinking about kind of moving out of November into January. So from a basis standpoint, there isn't anything obvious really with futures. You can see the curve here. This is legacy. This is the mini. So from a basis standpoint, and again, this was as of yesterday's close. You can see that November at 521 is probably a premium to certain mills, or even money with certain mills and physical cash. So for those that bought November in the sub 470 or sub 480 area into that 460 area, you might see some people releasing their futures now and then going to buy the physical cash because you've had the convergence take place.
Yeah, there's no basis for anything right now.
No. So there's nothing obvious with futures. Here's January. This March isn't updated, so ignore that. That's not real. So we'll look at open interest. Still maintaining a pretty good open interest in the legacy contract. Obviously, 1901 is massive in November relative to Jan. So there will be, and you're probably 2.5 weeks away before, this is still your lead contract, the November contract. So if the funds are coming out, you'll see this decline. If there's new selling or new buying, then you'll continue to see this trend up. But the funds obviously are all concentrated in the November futures here. So something to watch in that, if something dramatically changes, we know that the funds are short and what they could trigger if they decide to push the exit button someday. Here's CFTC numbers, and you did see off of the rail news kind of early last week. So this is as of Tuesday. You did have some managed money shorts exit the market. You had longs take profits. You had some new commercial type selling. And, again, this, I'm not going to react too much to this liquidating where this is your last in, first out type crowd. I think the bigger theme here is you just had liquidation outside of commercial shorts increasing. You pretty much saw profit taking all around. Liquidation, right, profit taking all around on that spike up last week.
This was measured on that Tuesday, right? And when you look at the chart, Tuesday was the high of the move.
So exactly.
This is what I'm looking at is every move up right now, we see managed money getting out. And right, the producers are hedging up. So, obviously the producers are pretty bearish right now. If you have Canfor curtailing production, and on any up move, you're seeing an increase in the short position of the industry. I think the industry is finally flipping its hat around and getting bearish.
Yeah, no, and I think look, you're always going to have managed money that gets washed out, but I think the meat of this position really has less to do with the underlying fundamentals of physical lumber. It has more to do with the underlying fundamentals of housing, the negative connotation with housing and interest rates. And with the FOMC tomorrow, unless there's some shift in the Fed's stance, if it's a bigger number than 0.75, you could have the funds just come in and annihilate futures. If it's 0.75, again, I think that's built in one way or the other. If it's less than 0.75, then you could have a freak out that way as well, where Powell,
the chance of it being less than 0.75 is so low.
Yeah, no, and I think the big thing obviously is what's Powell going to say, and I'm sure he's giving practice speeches right now to his speech writers and everybody that'll listen internally, just to see what words should I use, not use, to freak the markets out, because the markets are completely engaged in what the Fed is going to do tomorrow. And unless there's some kind of interest rate change here, stranger things have happened. It's the commodity funds. Maybe they wake up one day and just decide they don't want to be short futures, and that's always a possibility. But best case scenario for the industry from a production standpoint is these guys push futures up and get replaced by these guys. You will have a transfer of shorts at some point from the managed money side into the commercial side. But again, this managed money component is playing with house money, and that they've been short the last $400 a thousand.
And that's my take, is we're going to see the managed money liquidate, cover their shorts.
Yeah. And it could be into the seasonal lows. It could be after, this month, next month, the Fed kind of runs its course. And then here's the mini volume, trying to kind of work its way higher. Fortunately, we did see the January and March futures open yesterday, which is a good thing. So, I'll tell you that we're trying to push as many people that have stuff in January and March and beyond into the new contract. Let's support that new contract, because, as a reminder, the existing legacy contract is being grandfathered out. Whether it's March or still May, that's not going, there's no changing that. So people, like it or not, are going to have to trade this new contract. So we highly encourage people to start trading, adding liquidity, adding open interest, adding volume to the mini here.
Yep. And options, if you want to get into any sort of options, they're not opening up new option chains, so you're going to have to move to the
and I can tell you that people did ask the CME to reconsider creating January legacy options. So far the answer is no. If you want to do it in the mini contract. So November, as of right now, is the last official legacy options you can trade. If you're an option trader moving forward, it's all going to be done in the mini contract or the new contract. Rail stats quickly. I know with the strike news last week, you can see velocity is still improving. You're almost at the high water mark for the year, but Canadian, this was gummed up with, obviously, mills not shipping last week, just in general, Canada not shipping across the border because of what ifs. So you can see, originated Canadian rail traffic down, and then U.S. traffic down as well. And we'll chalk this up, outside of seasonality, but also to the strike. And then the one thing everybody knows, I'm a huge statistics guy, and I'm also a Browns fan. So the Browns lost to the Jets in just historical fashion. And so from a statistical standpoint, with 1:22 left, the Browns were a 99.9% probability to win the game. And, to say something is statistically, it's 100%, it's never 100%. And the Browns proved that on Sunday, where they blew a 13-point lead with a 1:22 to go against the Jets. The Jets had no timeouts. So this is just, again, Cleveland fans call these brownieisms. NFL teams have won the last 22, 29 consecutive games with leading by 13 points in the last 2 minutes. The last team to blow a lead, well, it was the Browns against your Bears in 2001. So, only the Browns can top the Browns. So
I think you should come over to the Green Bay Packer water. The water's a lot warmer. Everybody's just relaxed.
So that's what I have. Again, everybody trade mini futures, support the mini futures contract. It'll be interesting to see what the Fed does tomorrow, but that's what everybody's gonna fixate. And then just FYI, lumber just made a new high in November, 524.50 now. We're 524.10 last, up 41.90.
Yeah, my target is the highs from last Tuesday, 576.70.
Yep.
You know what? We go take that out, and from a technical analysis, it's a whole new ballgame.
So the one thing I'll say,
bottom in place.
I'm going to drag, and I know we're up against it. I'm just going to show one thing here. The thing that I'm watching, and it'll be interesting to see. So lumber's kind of got its line in the sand to the downside at 450. The S&P, here's the S&P, this 3854 area. That's today's low. Failure of the S&P into this 3850 area is going to project a massive washout to 3720, 3710 for starters. So you could get this big flush in equities, failure to hold, and you can look at this in the NASDAQ, you can look at this at the Dow. You're at this line in the sand moment for equities where if you don't hold here and bounce, the projections are significantly lower where you're going to go back and take potentially retest those lows that we had back in June. That's within striking distance now. So I think tomorrow's, and you better believe the Fed, you're going to see what the Fed truly wants with what they say tomorrow. Because again, if we break down underneath here, you get a much more severe flush in equities as a whole in the coming days, coming weeks here. So this is a major inflection point for equities right now.
Got it. All right, yeah. Next week it'll be interesting to see where we're at.
Yeah,
So,
always good stuff.
And one thing I'd like to bring up, Greg Kuda and I were both at the BCMC show, Building Component Manufacturers, and the Framers Summit. There's a lot of people very interested in risk management. So I think we're going to see an increase in just the amount of opportunities to be trading moving forward.
Yeah, absolutely. I appreciate it. Thanks, Mike.
All right. Take care. Bye-bye.
Thanks, everybody.